On February 28, 2026, the world woke up to news of war. Satellite images showed missile trajectories over the Middle East at night. Headlines and scrolling news feeds exploded. Missiles had struck targets inside Iran. The joint U.S.-Israeli operation began on a Saturday, a day of rest for many global markets.
The United States military is undertaking a massive and ongoing operation.
The stated goal was to dismantle Iran's nuclear program and induce regime change. The immediate result was chaos. The Iranian supreme leader, Ali Khamenei, was reported dead in the initial attacks. This was not a small skirmish. It was a direct, powerful blow against a major regional power. The shockwaves did not wait for Monday morning. They rippled through the world instantly, creating fear and uncertainty. Investors felt the shock immediately. People want to sell what they perceive as risky and buy what they perceive as stable. But on that Saturday, most traditional avenues were closed. The New York Stock Exchange was silent. European bourses were dark. Asian markets were hours away from opening. This created a unique and challenging situation. Money was desperate to move, but most of the roads were blocked. The desire to react was immense, but the ability to do so was severely limited for most people holding traditional assets like stocks and bonds. This sudden stop in trading highlighted a fundamental weakness in the old financial system. It was built for a different era, a time before instant global communication and 24-hour news cycles. The system takes weekends and holidays off, but geopolitics does not. Crises can happen at any time, on any day. When the dust began to settle and markets reopened, the damage was clear. The initial panic caused a massive sell-off in assets tied to global economic growth. The numbers tell a story of fear and rapid capital flight. Since the first strikes on February 28th, global stocks have taken a significant hit. The S&P 500 is down approximately 5.4%. The Dow Jones Industrial Average has fallen about 6.9%. Japan's Nikkei index plummeted 11%. India's Nifty index dropped 7%. The MSCI World Index fell by about 4%. Iran threatening to close the Strait of Hormuz sent oil prices soaring by over 40%, adding another layer of worry for the global economy. It threatened to fuel inflation and slow growth. Real estate in hubs sensitive to geopolitical risk, such as Dubai, fell between 20 and 30%. Amidst the red, Bitcoin staged a remarkable recovery. It first fell to around $64,000, then climbed to an overall gain of about 7%. While stocks and bonds froze over the weekend, Bitcoin traded, absorbing the shock and rising. Panic sell, fast recovery, volatile consolidation. History is not repeating, but it is rhyming. Gold's performance during this crisis has confused many who expected it to soar. The textbook rule says, when geopolitical risk rises, gold should rise. It is the asset of last resort, a store of value that has outlasted empires. Yet as missiles flew and markets trembled, gold fell by over 5%. It has an often inverse relationship with the world's reserve currency, the US dollar. Gold remains a powerful store of value, but short-term moves can be dominated by currency flows. Let us go back to history. Every time the world burned, money moved. The 2008 global financial crash drove investors out of credit and equities. Stocks plummeted, real estate crashed. Gold rallied above 40% over 2 years, after the initial liquidity shock. In 2020 COVID crisis, gold hit all-time highs. Bitcoin rose from under $5,000 to over $60,000 within 18 months. In 2022, energy and inflation spiked as a result of Russia-Ukraine war. Bitcoin dropped, then recovered. Gold spiked, then retreated as rates rose. Real estate boomed on low rates, then crashed on rate hikes. The current crisis follows this script, but now with a mature, liquid Bitcoin market and the emergence of tokenized assets. The most significant story may be how Bitcoin behaved. While traditional markets were closed, Bitcoin was open. It trades 24/7, 365 days a year. Its ledger never closes. When the strikes hit on a Saturday, it was the only major market where investors could react. By the time Asia and Europe market opens, Bitcoin had already absorbed the shock and trended up. This 24/7 liquidity is a superpower in crisis. An investor in Seoul could move at 3 a.m. Sunday, a Zurich manager could reallocate without waiting for the bell. Continuous access prevents pressure buildups that cause chaotic gap downs. It is not a replacement for gold, it is complementary, digital, borderless, supremely liquid. In this crisis, Bitcoin charted its own course. Beyond gold and Bitcoin, a quieter shift is underway. There's a new asset class in the playbook. It's tokenized real-world assets. Tokenization converts ownership of a physical or financial asset into a digital token on a blockchain. This can be real estate, a government bond, a private share, or a work of art. Tokens can be traded, settled, and managed on-chain, with 24/7 availability. This isn't futuristic, it's happening now. Analysts project tokenized markets could reach trillions by 2030. A key driver is tokenized U.S. Treasuries. BlackRock's BUIDL, launched in 2024, helped expand on-chain treasury products. Tokenized treasury products reached roughly $5.8 billion on-chain by March 2026. While physical real estate froze and bonds were bound by hours, tokenized platforms operated smoothly. Investors held stable assets with on-chain liquidity and instant settlement. BlackRock, JP Morgan, Citibank, and others are not asking for permission. They are building the new rails. Now let's do an honest comparison between gold versus stocks versus Bitcoin versus real estate versus RWA. Gold remains a powerful hedge against systemic collapse and debasement. Its weakness, sensitivity to dollar strength and liquidity crunches. But physical gold is illiquid, logistically complex, and dollar sensitive. Stocks excel at long-term growth, compounding productivity and profits. The stock market is the biggest loser. Stocks are sensitive to inflation fears, rate uncertainty, and geopolitical shocks. Bitcoin is at $68,000, down from $100,000 in January, but holding. Bitcoin is the only liquid large non-sovereign asset that trades 24/7 during any crisis. Its weakness is volatility and evolving regulation. Real estate is tangible with rental income and deeply illiquid. Dubai fell by more than 30% in 3 weeks. Globally, real estate is under severe stress. Tokenized real-world assets have no borders. That is the future, and it is already here. Tokenized RWAs blend real asset stability with digital liquidity and access. The weakness is novelty. Frameworks and familiarity are still developing. RWAs trades at 3 a.m. in Singapore on a blockchain while missiles fly in war zones. Tokenized U.S. Treasuries are at 5.8B on-chain with 4.8% yield, held steady through war. RWA market growth is 380% from $5 billion in 2022 to $24 billion in 2025. RWA on-chain value is up 140% in the last 15 months. Private credit on-chain has 180% growth at $16.8 billion. McKinsey RWA projected target by 2030 is $2 trillion. Bonds give income, ETFs give access, but both ride old rails with limited hours and slow settlement. And the winner for crisis resilience is gold, short-term, Bitcoin, medium-term, RWA, long-term. Navigating uncertainty requires a clear plan across 3 horizons. Do not apply long-term strategies to short-term problems, or vice versa. The market shock due to geopolitical situations left investors with no immediate liquidity alternatives. Gold faltered under a stronger dollar. Bitcoin absorbed panic with 24/7 liquidity. Tokenized markets stayed open, settling instantly across borders, built across systems, the best of the old and the innovations of the new. The prudent strategy is to build a foundation for the future that is resilient across multiple futures and rails. Invest in gold for stability, Bitcoin and native digital assets for medium-term resilience and faster liquidity, RWAs for long-term growth.